Hello everyone, hope you all are fine and preparing for the upcoming exams. In today's video, I will show you how to present the cash flow from operating activities in a cash flow statement in the indirect method. And this I'm going to show with the help of a basic problem sum. A cash flow statement is generally prepared with the help of a income statement, that is the profit and loss account, and the balance sheet. So it is important to have a thorough knowledge about these two statements. In this question, we have to calculate the cash flow from operating activities. Here, the profit and loss account for the year ending 31st December 2017 is given to us. The question also gives us the information related to current assets and current liabilities, and the values of these assets and liabilities are given for two dates. That is, as on 31st December 2016 and as on 31st December 2017. These are actually the opening and the closing values for the year 2017. Now, with the help of this information, we have to prepare the cash flow statement showing the cash flows from operating activities. Before I start, let me show you the format of a cash flow statement. The heading we write as cash flow statement, then it is followed by the word for the year ending, and in this case it is 31st December 2017. Then we have the particulars column followed by two amount columns. The first amount column is for writing the detail amount, and the final amount is presented in the last amount column. Then we start by writing A, cash flow from operating activities. Under cash flow from operating activities, the statement starts with net profit. So in our question, in the profit and loss account, we can see the net profit is 80,000. So we write net profit rupees 80,000. Before I proceed forward with the solution of this question, it is important to know that a cash flow statement is generally prepared by a company, though it can be prepared by other businesses also. So it is also important to understand the profit and loss appropriation account of a company as it affects the preparation of a cash flow statement. Since you all are familiar with the profit and loss appropriation account of a partnership business, so let me show you the comparison of the profit and loss appropriation account of a partnership business with the profit and loss appropriation account of a company to make you understand the appropriation account of a company. Now, generally a partnership firm prepares a profit and loss account at the end of the year, and the net profit or net loss is transferred to the profit and loss appropriation account. Let us take for an example that the net profit of the firm is rupees 8,000. Now this 8,000 rupees will be transferred to the profit and loss appropriation account. This 8,000 rupees can be divided in the form of interest on capital to partners, or to partners' salary, or to partners' commission, or a part of it can be kept aside as general reserve, and the balance of profit, if any, will be transferred to the partners in the profit sharing ratio. Similarly, a company also prepares a profit and loss appropriation account, but the division of the net profit is slightly different from the partnership business. But the concept is almost same. Now, a company generally prepares an income statement at the end of the year, that is the profit and loss account, and the net profit is transferred to the profit and loss appropriation account. Now, let us assume that the net profit of the company is 8,000. Now, this 8,000 rupees will be transferred to the profit and loss appropriation account. Now, this 8,000 rupees can be divided in the form of provision for tax, or to interim dividend, or to proposed dividend, or a part of it can be kept aside as general reserve, and the balance of profit, if any, will be shown on the liability side of the balance sheet. Now I hope you have understood the profit and loss appropriation account of a company. Now if in the question they give us the balance of profit, for example here it is 2,000, and they have not given us the net profit, or what we call it as net profit before tax, and they have also given us the information related to the deductions in the form of provision for tax, interim dividend, proposed dividend, and general reserve. If all these deductions are given in the question and also the balance of profit, then in order to calculate the net profit or the net profit before tax, the simple way what we have to do it is, the balance of profit that we have in the question, we add all the deductions which are made in the form of general reserve. In this example it is 3,000. We add proposed dividend, which is deducted from the profit, 1,000. Interim dividend in this example is 500 rupees, we add it back, and provision for tax is also added back. So finally what we get is the net profit or the net profit before tax. Now, if in the question, if they give you the balance of profit, and if they give the deductions in the form of provision for tax, proposed dividend, interim dividend, or general reserve, or if they give any of these or all of these, we have to add it back to the balance of profit so that we can get the net profit before tax. And this is important in the statement because the statement starts with net profit before tax. Let us get back to our question. We have already started with the net profit, which is 80,000 in our statement. Look at the profit and loss account of this question. We find that the payment for tax is rupees 36,000 for the year. But in the question, the provision for tax made for the year is not given. So in this case, we assume that whatever the provision for tax made for the year, the same amount is taken as payment for tax for the year. So rupees 36,000 is the provision for tax made in this year, and the same amount of rupees 36,000 is made as payment for tax. So we have to remember this. Rupees 36,000 is the provision for tax in the sum, and as well as rupees 36,000 is also the payment for tax. Since the provision for tax for the year is rupees 36,000, so in order to calculate net profit before tax, we have to add this 36,000 to the net profit rupees 80,000 in order to get net profit before tax. There is no other appropriation like proposed dividend, interim dividend, or general reserve. So our net profit before tax would be rupees 1,16,000. After finding the net profit before tax, our next step is to find the operating profit from the profit and loss account. So we need to understand the profit and loss account and the items of this account. So we should know that the profit and loss account is prepared on accrual basis. That means it includes both cash and non-cash items. It also includes non-operating items, but the cash flow statement is prepared on cash basis, and for finding operating profit, we have to take only operating items. Now for calculating operating profit, according to accounting standard 3, we have to follow the indirect method. But before explaining you the indirect method, let me show you the simplest way to calculate the operating profit. Then I will show you the indirect method that we actually need to follow in the statement. Now to calculate operating profit, we should take only those items which are operating and cash. We should not take those items which are non-operating and non-cash from the profit and loss account. So starting from the credit side, we can take sales, which is an operating item, and it will show an inflow of cash of 12 lakh rupees. We should not take by profit on sale of land and interest, as these are non-operating items. Now on the debit side, we can take cost of goods sold, which is an operating item, and it will show an outflow of cash of 7,75,000. Now cost of goods sold actually includes purchase of goods for resale or for production, and it also includes direct expenses like payment for wages or carriage, etc. Then we can take office expenses, which is an operating item, and it will show an outflow of rupees 65,000. We can take selling expenses, which is also an operating item, and it will show an outflow of 1,50,000. We cannot take depreciation, though it is an operating item, but it is a non-cash item as we do not pay any money for depreciation. So this 72,000 rupees will not be taken as an outflow of cash, as it is a non-cash item. And we cannot take loss on sale of plant, as that also is a non-operating item, and goodwill written off also is a non-operating item. So these three items like depreciation, loss on sale of plant, and goodwill written off will not be taken under cash outflow from operating activities, as these are non-cash and non-operating items. Now if we show our calculation, this is how we can do it. Sales will show an inflow of cash of rupees 12 lakh. Then cost of goods sold will show an outflow of cash of rupees 7,75,000. Office expenses will show an outflow of cash of rupees 65,000. And selling expenses will show an outflow of cash of rupees 1,50,000. Now after the calculation, what we will get is the operating profit before working capital changes. And here the operating profit before working capital changes would be 2,10,000. But according to accounting standard 3, we have to show the operating profit in the indirect way. That is by adjusting the net profit before tax, which is on accrual basis. That means we will adjust the net profit before tax by adding all the non-operating expenses and non-cash expenses, which actually decreases the profit, and deducting all the non-operating incomes and non-cash incomes, which actually increases the profit. So here we adjust the amount of rupees 1,16,000, which is our net profit before tax, by adding back depreciation, which is an operating item, but it is a non-cash item as we do not pay cash for depreciation. So this 72,000 will be added back to the profit as it has decreased the profit by 72,000. Then goodwill written off will be added back to the profit as it is a non-operating item and it decreases the profit by 10,000. So this 10,000 will be adjusted by adding it back to the profit. Then loss on sale of plant also is a non-operating item and it decreases the profit by 30,000. So we add back this to the profit for adjustment. So 30,000 will be added back. Now again, profit on sale of land is a non-operating income and it increases the profit by 15,000. So we have to deduct this from the profit as an adjustment. Then interest received also is a non-operating income and it increases the profit by 3,000. So we have to deduct this 3,000 from the profit as an adjustment. Now after the calculation in the indirect way, what we get is the operating profit before working capital changes. So our operating profit before working capital changes is 2,10,000. Now in the cash flow statement, we have to show this in the indirect method. So we have to follow the indirect method. So after finding the net profit before tax, that is 1,16,000, we write adjustments related to non-cash and non-operating activities. Now, first of all, we will add all the non-operating expenses and non-cash expenses. So they are depreciation, loss on sale of plant, and goodwill written off as an adjustment of the net profit before tax. So we'll be adding to 72,000, 30,000, and 10,000. Next, we will subtract profit on sale of land and interest received as they are non-operating income and they will increase the profit. So we will subtract 15,000 and 3,000 respectively. So after the calculation, we get 94,000 and we are going to add this 94,000 to the net profit before tax, that is 1,16,000. So after adding 94,000, we will get 2,10,000, which is our operating profit before working capital changes. So we will write here operating profit before working capital changes. So it is 2,10,000. Now after operating profit before working capital changes, we write the heading as adjustments related to current assets and current liabilities. Now let us look at the second part of our question. They have given us the information related to current assets and current liabilities. They have given us the values for two dates, that is as on 31st December 2016 and as on 31st December 2017. These are actually the opening and the closing values for the year 2017. Now, if you look at debtors, the opening value was 1,40,000. Now the closing value is 1,64,000. That means debtors have increased by 24,000 during the year. Now, if you look at stock, the opening value was 84,000. Now the closing value is 1,15,000. So stock also has increased by 31,000. Now, if we look at creditors, which is a current liability, now creditors opening value was 60,000. Now the closing value is 73,000. So creditors have also increased by 13,000. Now if you look at office expenses outstanding, the opening value was 6,000. Now the closing value is 4,000. So office expenses outstanding has decreased by 2,000 rupees. Now, before I explain you how to show the inflows and outflows of cash from current assets and current liabilities in the cash flow statement, you have to understand this concept that if there is an increase of current assets during a year, we assume that there is an outflow of cash from the business. And if current asset decreases during a year, we assume that there is an inflow of cash in the business. And for current liabilities, if current liabilities increases during the year, then we assume that there is an inflow of cash in the business. And if current liabilities decreases during the year, then we assume that there is an outflow of cash from the business. Let me explain you the concept with some examples. If current asset increases, we assume that there is an outflow of cash. To explain you this, let me take the example of stock. Stock is a current asset, and let us assume that the opening value of stock to be 10,000 and the closing value to be 12,000. Now there's a difference of 2,000. Now we assume that the business has purchased more goods during the year and it had to pay rupees 2,000 for purchasing the goods. So we can conclude that if current asset increases, there is an outflow of cash. Again, if current asset decreases, we assume that there is an inflow of cash. To explain you this, let me take the example of debtors. Debtors is a current asset. Now let us assume that the opening value of debtors to be rupees 5,000 and the closing value to be 3,000. There's a decrease of rupees 2,000. Now we assume that the business has received more cash from the debtors during the year. As a result of that, there is an inflow of cash of rupees 2,000 into the business during the year. So if current asset decreases, we assume that there is an inflow of cash. Now, if current liabilities increases, there is an inflow of cash. To explain you this, let me take the example of prepaid income. Now, prepaid income is a current liability. Now, let us take the prepaid income as advance received from customers. Now, it is a current liability. Let us assume that the opening value of advance received from customers is rupees, say, 7,000 and the closing value to be 9,000. Now, there's a difference of 2,000 rupees. We assume that the business has received further 2,000 rupees from the customers as an advance. So the business has received 2,000 rupees cash during the year. So there is an inflow of cash of rupees 2,000. So if current liabilities increases, we assume that there is an inflow of cash. Again, if current liabilities decreases, we assume that there is an outflow of cash. To explain this, let me take the example of creditors. Creditors is a current liability. Let us assume that the opening value of creditors to be, say, 7,000 and the closing value to be rupees 5,000. There's a difference of rupees 2,000. We assume that the business has paid rupees 2,000 to the creditors. As a result of that, the creditors have decreased by 2,000 during the year. So there is an outflow of cash of rupees 2,000 as payment to creditors. So if current liabilities decreases, we assume that there is an outflow of cash. Let us look at our question. Keeping the concept in mind, let us separate the items first into current assets and current liabilities. Debtors are current assets, stock is a current asset, creditors are current liability, office expenses outstanding is a current liability. Now if we look at debtors, the opening value was 1,40,000. Now the closing is 1,64,000. So there is a difference of 24,000. Now we assume that there is an outflow of cash because debtors are increasing. If current asset increases, we assume that there is an outflow of cash. Then if we look at stock, the opening value is 84,000. The closing is 1,15,000. There is a difference of 31,000. And we assume that there is an outflow of cash because stock is increasing. If current asset increases, we assume that there is an outflow of cash. If we look at creditors, we can see that the opening value is 60,000 and the closing is 73,000. There is a difference of 13,000. We assume that there is an inflow of cash because creditors are increasing and creditors are current liability, and if current liability increases, we assume that there is an inflow of cash. If we look at office expenses outstanding, the opening value is 6,000, the closing is 4,000. There's a difference of 2,000, and we assume that there is an outflow of cash because office expenses outstanding is decreasing and current liabilities decreases, we assume that there is an outflow of cash. Now, after calculating the increase and decrease in current assets and current liabilities, now we will place this item in our format. Now we write adjustments related to current assets and current liabilities. Now below that we write increase in creditors 13,000, increase in debtors 24,000, which is an outflow, increase in stock 31,000 outflow, decrease in outstanding office expenses we show as an outflow of 2,000. Now after calculating the increase and decrease of current assets and current liabilities, we get a total of 44,000 as an outflow. Now we adjust this amount with 2,10,000, and what we arrive it as cash generated from operating activities before tax as 1,66,000. Now in our question we have a payment of tax of rupees 36,000. Now the same amount will be treated as provision for tax, which we have already adjusted at the beginning. Now we will show this payment for tax of 36,000 as in our format as less tax paid. So we will show it as less tax paid rupees 36,000, and we will deduct this from cash generated from operating activities, which was 1,66,000. Now after calculating that, what we finally arrive at is net cash from operating activities, and we get here as 1,30,000. Now the steps to calculate cash flow from operating activities that we followed were: number one, firstly we calculated the net profit before tax. Now if in the question, if there is any item like provision for tax, proposed dividend, interim dividend, or general reserve deducted from the profit, and our net profit before tax is not provided to us, then we add all these items back which have been deducted from the profit so that we get the net profit before tax. After getting the net profit before tax, we adjust all the items of non-cash and non-operating activities which has affected the net profit before tax. After the adjustment, we get the operating profit. Now, the third step that we followed was to adjust the current assets and current liabilities. After the adjustments of current assets and current liabilities, we get cash generated from or cash used in operating activities before tax. If there is any payment for tax, so in our fourth step, we deduct the tax. Then what we arrive at is known as the net cash from or used in operating activities. So I hope you are clear with this video how to calculate the cash flow from operating activities.